Welcome to the students of financial accounting class created by business team. Um, our discussion will be around chapter 3, which is about income statement. So in this kind of a short video, we'll cover the issues of creating income statement and creating a pro statement analysis based on a sales data, and also we will cover the issues of trend analysis and few ratio analysis. So basically we start with the how to build the income statement. So let's suppose that, for example, we have a company named Elvis Products International, and this is its income statement for the year ended in 2004 December 31st. What we initially need is data for 2003. We have been provided with this information from the previous uh, um, financial statements of the company. So let's input this data and come up with the net income. So how we do that? We have the information regarding sales. So this is basically this 433,000. So we just input the numbers that we've been provided previously. So what we need to calculate right now is the gross margin, which is basically sales minus cost of goods sold. So remember, whenever there's some formula where is any data depending on some other inputs, it's better to do it using by formula. So instead of inputting a raw number in here, we use a formula. So as you saw, it's basic formula, and now we come up with another input number, which is selling and general and administrative expenses. We have also an item called fixed expenses, and also depreciation. So as you might have read from the chapter 3, the depreciation expense is the allocation of fixed assets costs throughout the period of its useful life. So we add this expense as well to our income statement. And now we calculate the earnings before interest tax, so it's EBIT, let's say that way. And this is basically, we make a formula like this. So we add this number, gross margin, and minus the sum of the previous numbers. So this is it. This is the number we come up with. And now we also deduct interest expense. And then we calculate, and now we add the final item, which is earnings before taxes. And again, simple formula. And now I've covered the number, and now we need to calculate the tax. In order to do it more, let's say, dynamic way, we just add another item below, which is tax rate, and we make a percentage style in here, and we just add the number 40%. So let's assume that it's 40% corporate tax, and we add this item tax rate, tax, and just calculate it. So this one, it multiplied by 40%. So this is our number. Let's add some columns in here. Let's repeat by pressing F4. So repeats this step, and now we have net income number, which is basically the deduction of the tax. So here we go. This is our last number. Let's highlight it as well and make it italic. So this is our final number on the net income. So how we should proceed now? And now we need to add another column in order to build a common size income statement. Common size income statement meaning that the income statement based on the numbers, or based on the percentage of the previous sales data and percentage ratio against cost of goods sold and other income statement items. So we add another column in here, and let's make the size so 2003 percentage, let's say that way. And so let's assume that the sales data figure actually makes 100% because this is the data we get it actually from. And let's make this the formatting of this actual place by percentage, so in order to make it easier for us. And now we calculate the percentage according to our sales data. So we divide the figure that we have by the sales data, which is C5. So this means 83% of our sales data makes up cost of goods sold. And in order to drag this item further and not to repeat this formula again, we just add dollar signs to each of them. And now we can easily drag this down from here. And we have the numbers for them. And let's add some decimal places. So this is basically the percentages that we have got for the items that we have. We'll come back to the formatting later on. So for now, we just build our income statement. So in order to save some time regarding inputting this another data for 2004, we just edit this item quickly at the same way as we've done before, with the same formulas as you may see from here, and the same ratios. So as you may see, for simplicity, we also included the data that we provided, and we just basically inputted this data in our 2004 column, and also we have calculated the same way as for 2003. So we actually took this number and divided by the sales number, so we've come up with a percentage of sales. So right now we're going to build a common size income statement based on the our projections of sales, and using this projection we'll actually build the rest of the income statement and project the net income that we might earn, for example, in 2005. So let's assume that for this example it's 2004 end of year, and 2005 is actually the future year for us. First of all, what we need to do is just add some columns in here. So let's add some columns, adjust their size, and now what we need to do is basically to input the data based on our past information that we have. Let's assume that our sales data for the 2005 projected by our marketing department will be 4,300,000. And in order to calculate the other inputs such as cost of goods sold, selling and G&A expenses, fixed expenses, depreciation expense, and interest expense, we'll use the average of previous year's percentages. So meaning that, let's say this will always stay as 100%. We actually make a format in here of percentage, and we take the average of these two items. So we add up 2003 and 2004, and we just delete it by 2. So by this way we take the average of this years and we just drop it down that we have. So let's make some percentages in here, and now we're gonna build our sales data in the whole income statement based on these percentages